Hi, and welcome to the ECIO fourth quarter capital markets review. The fourth quarter was a good quarter for investors as stocks were up 0.2% to nearly 3% in the US, overseas about 4.5% to nearly 5%, and fixed income results were up 1% to 1.2%. That takes returns for 2025 up in the US 4.5% to nearly 18%, overseas over 30%, and for fixed income results up over 7%. It has been a tremendous year as the S&P 500 has gained nearly 18% in 2025. It has been volatile, that starting in mid-February with concerns over trade and tariffs, leading to nearly a 20% downdraft. That was followed by a rebound starting in mid-April through the end of the year, up about 37%. So it has been a tremendous year. When we look at sectors, there were three sectors that led the way higher. A lot of that was concentrated in the technology and communication services stocks. The other 8 sectors actually lagged the overall performance of the S&P 500. So it was a somewhat narrow market. Again, the S&P 500 up 18%, led by the mega cap technology stocks, and that was supported by optimism around artificial intelligence or AI. We also saw international and emerging market stocks outperform. That was driven partly by a weakening US dollar and also by multiple expansion, the amount that investors were willing to pay for a dollar of earnings. Bonds also delivered solid gains. So the US benchmark indexes were up about 7% as falling treasury yields boosted prices, and income or interest income was also very strong, making one of the best years for fixed income investors since 2020. On the economic and policy front, we saw the Federal Reserve cut interest rates 3 times, once in September, October, and December. That totaled 0.75%. They did indicate in December that they believe policy is more close to neutral now. So that implies perhaps fewer cuts as we look into 2026. U.S. trade policy also tightened as broad tariffs were announced. The goal there was to bring back manufacturing to the U.S., but that, of course, increased significant uncertainty around the globe, although trade volumes coming into the U.S. did still see modest growth. A lot of that happened on the front end in anticipation of these tariffs. We did see the labor market cool throughout the year, slower job growth and slower wage growth, although unemployment has remained at a relatively low level. We also saw inflation ease, but stay well above the Fed's 2% target. So that keeps policymakers, the Fed in particular, somewhat in a quandary as to what to do to keep the job market strong, but not cause too much inflation. We saw consumer and business sentiment weaken throughout the year. It was pretty volatile, but point to point, we did see those numbers decline a bit. That was driven by uncertainty over trade, interest rates, and elevated prices. Overall, economic growth in the U.S. stayed positive. It was down from the previous year, but was supported by strong consumer spending, very significant spending on AI, which we'll talk a little more about in a minute. And then that was tempered by the higher tariffs and some of the tighter financial conditions in the market. So as we look forward into 2026, we think investors will remain focused on the labor market, consumer spending, Fed policy, inflation trends, and overall economic growth. Of course, geopolitical risks remain, and there's a lot of uncertainty still around trade. So investors will likely focus on those items in 2026. So that's a brief update for 2025. Since it's year end, I'm going to go into more detail on what drove the markets. If you have the time and the interest, please stick around. So starting off, first of all, with the S&P 500 and what drove those robust returns this year. This chart breaks it out between the Meg 7 stocks, so those are the big technology companies, and the other 493 companies. So you can see overall price return for the S&P 500 was up 16%, so that excludes the dividends. The Mag 7 stocks were up 23%, and the remaining 493 stocks were up about 13%. So about half the return came from those big technology companies. You can see that on this graph over time. In green are the Mag 7 stocks. They've done extraordinarily well. The gray line is the S&P 500, and the blue line are the 493 stocks, excluding the Mag 7 stocks. Now, some of that price performance has been justified, we think, because when you look at year-over-year earnings growth of the Mag 7 companies, you can see it's been extraordinarily robust. That's here in green relative to the other 493 companies. Now, having said that, when we look at the performance of those 7 companies over the past 3 years, what we see is in 2023, all 7 companies, and they're listed here, outperformed the S&P 500, in some cases by a very significant magnitude like NVIDIA and Meta. In 2024, we saw 6 of those 7 companies outperform the S&P 500. And then this year, there were just 2 companies, NVIDIA and Google or Alphabet, that outperformed, while the other Mag 7 companies actually lagged the overall return for the S&P 500. So it has gotten even more narrow as far as market performance. Now, looking at the top 10 companies in the S&P 500 over time and what percentage of the overall index those companies make up, if we start with 2025, and this was at the beginning of the year, so this is actually a bit more pronounced today, but at the beginning of 2025, the 10 largest companies in the S&P 500 comprised about $19 trillion of market capitalization. That was about 38% of the overall index. Now, at year end, this has gone up to about 41%, so it's even gotten more skewed. And you can see the significant amount that some of these big companies now comprise of the overall index. When we look back over different time periods in 2015 and 2005, 1995 and 1985, you can see the top 10 companies comprised about 20% of the index. So this is very unusual, kind of uncharted territory where these big 10 companies make up so much of the index. It's one of the reasons why we've been recommending, and in our portfolios, we are diversifying, maintaining exposure to the S&P 500, but complementing that with some of the dividend-paying and value-oriented stocks, along with small-cap and mid-cap companies. Now, as far as the technology goes, artificial intelligence has been a big part of the story, and that's a big part of what we believe would drive long-term economic growth and productivity. When you look at the capital expenditures or CapEx from the big AI hyperscalers, and those are listed here, these 5 companies, the amount of money they're spending is unprecedented. In 2024, those 5 companies spent $240 billion on capital expenditures for AI. In 2025, we don't have the final number, but we expect it to be about $400 billion. And in 26 and 27, you can see those numbers go up to about $600 billion. So huge amount of money that these companies are putting into AI. Now, one of the reasons they're doing that is because AI is being adopted at an unprecedented rate. Having said that, there is a long ways to go. When we look across companies and across sectors, about 17% of the companies have implemented AI in some of their business function. Now, that's expected over the next 6 months to increase to over 20%. That's this striped line here. And then you can see by sector, some sectors have adopted much more quickly and more robustly than other sectors. Some sectors are just not as conducive, like food service and perhaps warehousing, where you see lower adoption rates. Nonetheless, there is a long ways to go, we think, for AI adoption, and that's the reason you're seeing these companies pump so much money into AI. That also may be one of the key drivers for long-term earnings growth for those companies. Now, turning to overseas equity markets, the global equity returns, when we look back at what drove those returns, this looks back over the past 15 years. The annualized return for U.S. stocks has been about 14% per year. And that return has come from three areas. One has been earnings growth, which is this dark blue. The second has been from dividends, which is light blue. And the third piece has been from earnings multiple expansion. So the amount investors are willing to pay for earnings in the market has increased over the past 15 years by this amount in gray. Now, looking at other markets, the Eurozone has returned about half of what the US market has, more in the 7 to 8% range. Japan, 7%. Emerging market stocks, a modest 4%. And even China at 4% over the past 15 years. If we look at what happened in 2024, the US stocks did outperform. That again was driven by earnings, dividends, and then you did see more multiple expansion, meaning the market got even more expensive. The same thing was true with several of the other overseas markets. Here you see multiple expansion in China, less earnings growth. In Japan, robust earnings growth, but you saw currency negatively impact returns in Japan, the emerging markets in the Eurozone. That reversed out in 2025. So in 2025, as we pointed out, non-US stocks performed the best. Eurozone stocks gained about 40%. However, not much of that came from earnings growth or dividends. Most of it came from multiple expansion and from currency, meaning the US dollar weakened in 2025. It declined by about 9 to 10%. So that accounted for a pretty significant portion of the return in the market. The US market brought up the rear, but again, you can see earnings growth has been very robust in the US, pretty much stronger than any of the other developed markets. The emerging markets are the exception where they had very robust earnings growth. So to us, this signifies the strength of the overall US economy. The structure of the US economy is just much more conducive to driving productivity and earnings growth than many of the other developed markets, and is one of the reasons why we've maintained an overweight in US stocks relative to the overall global equity market composition. One of the other big issues in 2025 was, of course, tariffs. I think all of you are well aware of that. This chart you may have seen from us. It looks back over history and what the tariff rates have been going back to 1900. You can see they were extraordinarily high, and then since the mid-30s, really on a secular decline down into the 2000s, where we hit kind of the low at a tariff rate of about 2%, 2.5%. What was proposed in April, the kind of tariff tantrum, so to speak, was a 30% tariff kind of across the board. And where we're at the end of the year, proposed is about a 15, 16%. So that's been cut in half. What's actually materialized, the effective tariff rate, you can see month to month. So in September, which is the most recent numbers we have, it's at about 11%. So this has created a lot of volatility in the capital markets and in the supply chains, and will continue to be an issue that investors will be focused on, we believe, in 2026. One of the other big issues is the US dollar. I mentioned the US dollar did weaken. This chart on the right points that out. So this is the US dollar index over time. And you can see, that the US dollar has declined in 2025 by about 9.5%. Now, one of the driving factors behind that, we believe, has to do with our debt levels. And this takes a look at the federal deficit along with interest payments that we're making. So most economists believe that a long-term deficit can be supported at about the 3% level. Today, we're running closer to 7%. And you can see when you look at the components of that, the deficit itself is here in dark gray. And then the interest that we're having to pay is in light blue. So that's the concern, is that our interest payments, start becoming very, very significant, and potentially to the point where it's unsustainable. And so this is, we believe, taking a toll on the US dollar. Now, when we look at the overall accumulated deficits, so the total debt, we see today is equivalent to about the size of our economy. So about 100% of our GDP is the size of the debt today, and the projection looking out over the next 10 years is taking that up to about 116%. So it's something that we think investors are going to continue to be focused on. It's something that we believe we are going to have to address and bring this deficit and the overall debt level down in the future. Otherwise, we will be punished by investors. Looking at fixed income and bond results, so over time, this is the 10-year Treasury yield graphed out in dark blue, and you can see at the end of the year, the 10-year Treasury was just over 4%. So we are at a more normal kind of interest rate. When we take away inflation and look at the so-called real interest rate, so that's the stated rate less the inflation rate, that's what you get here in gray. And you can see for some time, we actually had a negative real interest rate. Today, again, we're at a more normalized level, and you can kind of see those numbers back relative to longer term averages. So we do have a more normal situation on the fixed income markets today than we had a couple years ago. You can also see that when you look at the Treasury yield curve. So this maps out 3-year Treasuries all the way to 30-year Treasuries and the rate that's being paid on them. Today, at the end of the year, is this dark blue line. So this would be a more normal curve, yield curve, where short-term interest rates are lower than long-term interest rates. Previously, we had seen an inverted yield curve, which you can see in 2023 in blue and in green, where short-term interest rates were actually higher than long-term interest rates. So we do have a more normalized fixed income market today than what we were dealing with a few years ago. That implies for investors that returns should be positive in fixed income. This graph looks at different data points and the starting yield of the aggregate bond index, and then the subsequent 5-year returns. So that's what each of these dots represent. The line is the regression line showing the average relationship. It's a very robust line showing that about 90% of the return can be attributable to the starting yield. So what that says today is investors should expect a return in fixed income markets in the 4 to 5% kind of range. And our thoughts are right in sync with that analysis. Stocks are a little more difficult as we look forward. This is the price earnings ratio, so the amount of how much investors are willing to pay for $1 of earnings. Today, as we close 2025, investors are paying $22 per dollar of earnings. That is a high level. It's over one standard deviation from the longer term average, which is about $17 per earnings. So what that means is, and what that forecasts is more modest returns for stocks as we look forward. Of course, predicting stock returns is very difficult, and this chart points that out. It looks at the S&P 500 return each year in gray, and you can see over this time period, going back to 1980, that 35 of those 46 years have resulted in positive performance, so about 3/4 of the time. Now, having said that, these red dots represent within each of those years the biggest drawdown or the biggest decline that was seen in each of those years. And you see some, very significant red dots down here, meaning that when you start looking at shorter periods of time within a 12-month period, you need to expect to see pretty significant volatility in the equity markets. Having said that, over long periods of time, again, 3/4 of the time, the market has been positive, and it's one of the reasons why we still remain optimistic about stock returns as we look forward over the long run, that being over the next 5 to 7 to 10 years. And it's one of the reasons why in asset allocation, we're so concerned about the investor time horizon for your pool of assets relative to how much exposure to stocks that we should hold. So that's a quick recap of what happened in 2025. There's a lot more to talk about, and we would be happy to meet with your investment committee if you'd like to dive into any of those details. Thank you for your time and interest, and have a terrific 2026. All the best.